What is going on, everybody? And in this video, we're providing you a state of the market and stock picks for February 24th, 2023. So if that sounds like something you're interested in, consider subscribing, as we do provide daily and weekly updates to get you prepared for the day and the week ahead in this glorious market. So today we had another dive, another retest essentially of the 3970. Now the question is we needed to hold. The Bears wanted this thing roughly around 405. We are playing around essentially all the daily, the monthly, and the weekly. So we're bouncing back and forth there. So yesterday, when we essentially, last 2 days, we've been kind of buttering through the support. And then today we had more data that did come out. This morning we had a lot. We had initial job claims. The actual was 192K. Previous was 195. Consensus was 200. So they expected it to go up, but it actually came down. GDP growth is down to 3.9. Previous was 4.4. Consensus was 3.5. So better than expected, but the fact it's starting to go down is definitely not a good sign. The PCE that came out today, actual was 3.7, previous was 4.3, consensus or forecast was 3.2 as well. So things are not looking good. And then you had Bostic come on today as well. Bostic really didn't have much to say today, so that wasn't very eventful, but nonetheless, the market is leaning heavily towards a 50-point basis move. Now, there was only expected to have 2, but now they're saying potentially 3 increases going into this year, and the next one being potentially a 50-point basis move and then rolling to 2 25-point basis moves. Is what they're talking about. As we are continuing to approach the next core, the percentage rate of a 50-point basis move is increasing. Now, given the data sets that are coming out, it's kind of projecting on what could potentially happen with the rate increases, and that's kind of been what we've been on par essentially with that forecast. As if it's a 50-point basis move or a 25-point basis move, Powell is essentially leaned pretty heavily on that. So projections have been pretty accurate. We'll have to see coming into tomorrow. Now, tomorrow we do have the PCE tomorrow. That's going to be important tomorrow. We do have some Fed members at 10:15 in the morning. Messner and Jefferson as well talking tomorrow. New home sales. We'll get some housing data at 10. Housing data really doesn't have a lot of weight. But the PCE will tomorrow. So that'll be at 8:30 Eastern Standard Time. So that's going to kind of give us what's going on with the consumer and see where they're at. Now, a lot of this data, like I said, is heavily manipulated. So it's hard to really decipher through all the mud what is true. But the fact is that, the housing industry, commercial real estate, has been folding before our eyes as well. So there is no people, especially this whole return to work drive that a lot of companies have been having, and a lot of people aren't returning to work because people after COVID don't want to be returning to work. So nonetheless, a lot of commercial real estate is essentially they can't meet their debt, right? And so they can't pay their debt. So they are folding before our eyes. Now, the next thing is what's going to happen. Rates or for housing in itself are extremely high, and they suffer the most when Fed raises rates. Now, moving forward, if we continue to do another 25, right? We said a lot of these big head bank CEOs and stuff are projecting that, once we'd hit 5% on interest rates, that would be it. We would be done. Between 5 and 5.25 is essentially where we would end it. And now they're projecting even more over that. which is going to be concerning because it's going to be even more unaffordable for homes. Obviously, they'll be the front runners on what could potentially happen moving forward. So again, 5% is what we're projecting. We're sitting at 4.75. So the next move, if it's over 50, right, we're going to get that 5.25 will be the top end of that. And so anything, if we get a 50-point basis move and then continue to add 25-point basis moves on top of it, that's going to blow projections completely out. Now we have to understand that going into the next core, we're going to get projections, right? If the next core is bad, we're going to get projections again, which we've been getting from the last core, and will kind of really mess with the market. That things that there may be another 50-point basis move, and so we'll get all that around mid March, and then once we get that information, the market's been moving off that projected data. Obviously, why we pushed up, because they were projecting things were going to be good, and then it's really been driving the market, and how the algorithms have been playing and institutions have been playing is because of that fact that it's based off of projections of what they're expecting, and people thought that things would be good, so the market's been pushing up, and it doesn't seem to want to die. But we have to see how it does play out. Again, things are not good. My opinion coming into this year, even with the inflation stuff, is I don't think we're going to see new lows on the inflation stuff. Unless we just all of a sudden continue to start laying rates on 50-point basis move, 75-point basis move, because inflation is running away. That can drive fear. Or Powell wakes up and says we're just going to start taking off rates, which, that is the chances of that happening are very, very slim. So those would be what could drive the market. But I think there's going to be a bigger black swan event that's going to potentially bring the market down to new lows. That's essentially what you would have, or we're going to continue to play this chop back and forth for another year until something breaks, right? And then when that thing breaks, that's what Powell said. Something needs to break essentially for him to start laying off rates. And right now, with a strong workforce, it's painting a different picture for the Fed, that they can continue to press harder with rates. And so again, before we hit phase 2 of this, the rates starting to come off, we're going to have to break something. Something's going to have to be broken or get high enough, which phase 1 may have to be reset. And that's what everybody was projecting, that we're moving into phase 2 of these rate increases, where they would be essentially seized and held at a certain rate. Essentially, we were aiming for that 5 to 5.25 is what we're aiming for, and holding that for the remainder of the year. But now it's looking like we're projecting to have to go over that, because inflation is getting hot. But how much more so? If inflation continues to rise, we continue to see really hot reports, and by God, we start breaking over 7, breaking over 8 on inflation, you're going to really drive fear, because that means that the Fed is again going to have to reset the clock and continue to raise rates, and going to pinch the consumer even harder than what they already are, just on the basic necessities. And understand that things will have to get worse. So what they're doing at some point will break something, and there will be panic and potential crash from what's currently going on. And again, the misleading information that everything's okay is very concerning, in people thinking that we could recover. But again, what is being placed in these headline news and everything primarily is driving the market. As long as there's expectations are being met, right? If you can project that expectations are going to be garbage, we saw that Carvana had a horrible earnings today, and yet they're still pumping. So this is something, we've had a lot of really bad earnings from great companies, and they're still pumping. So that should tell you something in itself, is that everything is driven off of expectations. It's driven off of headline news. and then we go from there. And it's going to take one bad report that's going to put something in headline news, and then that's going to start selling the market to potentially new lows. But again, it's all about timing and seeing how things play out. That's what we pretty much got. So tomorrow, we're kind of watching the PCE. I wanted to bring the monthly here. This is the kind of jazz we are dealing with. As you can see, we have these huge spikes in wicks, we did finally break above, and then wick. You can almost say the same thing happened here before we get that big dive down to new lows, and then we recovered. Is that the same play we're going to get here? We get a little bit more milder version of a push. Are we going to get another drop? And this is something I talked about before. Was our 684 point move up to a $830 point move down. Same thing. You can say from here. You take the bottom here from when we've pushed. We've had a 684 move up. We're going to get our 830 point move down, which would put us roughly around 3347. Is that correct? Yeah, that's one big jump down. So that's what I am thinking is potentially going to happen. Again, I think we have to see more pain. I think that leg down would be the pain, and that would be us over a 5% rate, and then maybe even higher. Again, if inflation starts getting hot, that's going to introduce something completely new into the markets. And then the Fed isn't going to care about anything else other than trying to get a hold of inflation, and the only way they can do that is by raising interest rates at this point. So they can't just let off rates and let inflation run through the roof. They can't just do that. And so the best way they can do that is by trying to pinch and destroy the consumer. And that's what their tool does, is to siphon all of their money, all of their assets, till they have nothing to kill demand. And that's essentially what the tool does. And so nonetheless, we shall see, because we are in a debt-based system, and that's what happens. To be able to do that, you have to destroy non-fixed rates on credit cards and everything that people are living off of. So people are getting charged more. Try to stop the spending is what we're trying to do, and the fact that the consumer is still spending is absolutely absurd on how that is currently playing out. So again, we'll see. But again, this doesn't look good. If this move repeats itself with another 830 point down, again, that puts us roughly around that 3,300. I was kind of guesstimating coming into this year around 3,200 would be our low. We'll see. Again, we need either one in all the projections for a 5 to 5.25 rates. If they get blown out of proportion and we're going to go over that, and potentially look at a 6% interest rates, I think that is going to mess up all projections and potentially scaring the market, as in what's the next move the Fed's going to do at that point. So again, very heavily data dependent on going forward, especially when you have this wide gap between monetary policies and cores. So we shall see what happens there. We'll flip this back to the daily, and then we will look at the dollar, which the dollar, again, I've been talking, if the bears can get this thing back over 105, I think it's pretty much game on from that point, and it is slowly grinding and pushing through these daily and weekly support. So I think in my mind, it's going to happen. I think you're just delaying the inevitable, and we're just any day we could wake up and this thing would be down. This thing would pop over 105 and start running back to new highs. So we'll have to see how that does play out. Bitcoin, something I've been talking about. If inflation starts getting carried away, where is Bitcoin going to go? Bitcoin needs to break again over the 25K mark, and it needs to hold the 23K mark. If it breaks below this, it does have some support here, roughly around the 21K mark. But then you start breaking some of these supports and you start heading back down to potentially new lows. I really do feel like I'm not a bear. I like to put that out there, but things are just too bad and you need more normalization. Housing still needs to come way down. Um, and a lot of other markets, the stock market still needs to be normalized a little bit more. We'll have to see, especially with what's going on with the banks, financials, and what's going on with the value. They've been holding overextended, something I've been talking about for quite a while, continuing to be overextended. Tesla very overextended, but is holding very well. Tesla needs to break out 215 if you want this thing to continue. If not, you don't want it to. Definitely don't want it breaking roughly the 180. If it breaks the 180, then you're going to correct quite a bit, potentially down to the 140. I think there's a strong possibility if the market starts selling. Again, it really depends on the panic. A lot of people were talking about this being completely oversold on tech. This had to do a lot with Elon selling shares too on top of everything. So that should tell you something, that he was selling all during this time to get money out. To potentially buying Twitter, but there's a reason for why he was trying to pull some money out, and so we have to kind of look and read between the lines on why he was doing that. He's a very smart man. He obviously knows what's going on, but inflation is a very big concern, and these guys are front running and seeing what's actually happening on the field, follow their footsteps and see what happens. So. All right, so NVIDIA, this is one I want to keep a very close eye on too. They did very well on earnings, but huge gap up. My thing is if this thing breaks roughly the 228, you're going to gap fill. There's going to be a gap fill at some point. It's just waiting for this thing to run out of gas. If we get bad data tomorrow, it could be the next thing that trips us and starts selling. If the market starts selling in general heavily, again, very overextended, this thing is going to at least gap fill back down to 206 and then potentially run down to 176. At least 50% of this move, I think, will be taken back. Again, if there's more fuel to whatever that is it's selling, we could see more of a new low on this one as well. But again, we have to wait and see. We have to see how price action is. Price action is battling every moment. The algorithms are still battling every moment with a lot of misdirection. And so you have to understand that. BA, again, watching the 203 for breaks there, could potentially make new lows roughly around to the 189. So watching that. Bulls, you want this thing again to continue over 122 or 222 if you want this thing to continue. But again, very overextended. It's been quite a while that this thing's been running, so I don't know if you want this thing to keep running the way it has been. JPM, same thing. It's consolidating quite a bit, roughly playing that 144 range down to the 137 range for breaks 137. You got support around 132, and again, it breaks that. I think, again, we're going to retrace at least 50% of this move, so I think we're going to be at least back at 124. Again, if that projection that I'm looking at on SPX of that 680-point move in the 830-point move down, I think it's going to come. The question is what's going to be that one thing that's going to break to kind of scare the market, and that may be inflation running back up, and then realizing that the Fed have to chase inflation and raise rates and increase more rates than currently projected. And I think that's the biggest thing you got to watch out for, is what's currently being projected and what could potentially happen there if those projections get way out of whack because inflation is running a lot hotter than they thought it was. So we want to see how everything is essentially going to play out. But like I said, right now, we have to watch price action. Price action is going to be extremely important. Right now, there's still a battle. There's a lot of essentially put covering, and so you're getting a lot of squeezes. You can essentially call it whatever you want. There is a lot of sell pressure, more than we've had in a very long time. Over the past year, it's really increased. So people are expecting things to break. We've seen that when we've trying to make that push up is the sell pressure is still greatly there. The sellers will give some back, but ultimately understand that things will break at some point, and the market's ready for it. So the market knows there's one more leg down. I can see that in the price action, and the market tries to take advantage of that. But we see that, like I said, there's a lot of your fighting algorithms and that are essentially being held up by emergency bond buying as well. Right at the beginning of the week, we had emergency bond buying um, by Japan. So we really have to see again what's going to happen moving forward from here. But with all that being said, if you've made it this far, go ahead and comment down below your thoughts, thesis, and ideas. What you're projecting of the market, how you forecast inflation, and what could potentially be happening. And aside with that, I ask that you could be nice and kind and drop a thumbs up. And until next time, I'll see you guys later.